Okay, this is Aussie dollar H1 chart. So as you can see, the entire chart, there's no clear trend, clear obvious trend, be it an uptrend or a downtrend. There's no obvious direction. And if you look at the fundamental side, yes, the CPI from China is improving, surprise on the upside, so that gives Aussie some push. But if you look at it, the US dollar is also on the strong side. So if you look at this pair, imagine it in a tug of war, it would be a strong team versus a strong team. The Aussie and the dollar, if the Aussie is stronger, it will pull the Aussie dollar higher. Of course, if the dollar is stronger, it will pull the Aussie dollar lower, this currency pair lower. So at this point, both currency are considered fundamentally strong, on the strong side. So of course, to trade this pair, since there's no preference on the fundamental side, then the other way is to look at it from a technical point of view and to look for any trading opportunities. And on the technical side, there's no obvious uptrend or downtrend. So I would apply again support resistance to tell me where are the possible decisions area of the market. That means area whereby decision is being made. So I'm going to put in the region. Okay, the immediate one of course is 0.7685, and the below one is 7655. Just give me a moment. Okay. So this would be the two regions that I'll be watching out for. So once price hits into the region, which is around 0.7685 or 0.7655, these two areas is basically what I call decision area, where market is likely to make a decision. So I'm going to change the color of the area. Okay, this will be the area. That means there are possibility of 4 trading opportunities. I'll mark them in green box to explain. Okay, so we'll start off with the lowest green box at the bottom. So when price hit into the orange area, then the next thing I want to see if the price close lower. Okay, close lower into the green box or lower, that would be my signal to go short. However, if the price did not breach the area of 0.7655 plus minus, and then it retraces up to the green box. So if there's a bullish engulfing patterns or there's a bullish candlestick pattern, that gives me an entry in the green box or around the green box or slightly higher than the green box. That would be my entry to go long. And similarly for the third green box, I want to see price hit into the orange area, and then once it turns down, give me a bearish candlestick formation, and that will be my signal to go short. Of course, if that did not happen, prices go beyond and close higher than 7685, close into the top green box or higher, that would be my signal to go long. So for this Aussie dollar, I've seen 4 different possible trading opportunities. So of course the price is in the middle of nowhere now in my point of view. So from here the price is 0.7667. From this point, price can go either up and down. I'll just stay and watch until my criteria is fulfilled before I go in for a trade. Okay, some of you have requested Aussie dollar H4, but I've covered Aussie dollar H1, so I'll keep it as H1 in order not to confuse everyone. So thank you for the reminder to put a vertical line for current time. Thank you very much. I'm so glad that I get a reminder. It just shows that you have been attending or supporting my webinar. So thank you very much. Okay, I'm zooming in the chart so that now it becomes more visible. And I'm going to put some price labels so you have a reference to the green box. Okay, roughly what are the price area that I'm looking at. Okay, the bottom one is about 0.7650 plus minus. That's where the green box is. For this green box is about 7660 plus minus or higher, 7660 or 7661 or 2. And this green box is about 7680 plus minus. And the top one is 7690. Thereabout. Okay, there's a question. May I ask a question, please? Why is Aussie always so tough? When you mention why is Aussie always so tough, it is not always so tough. It depends on which time frame you are looking at. But if you track back, Aussie has been weak in a way since they start slashing interest rate. So every time they slash their interest rate, it becomes weaker and weaker. So until recently, where they slash until a record low of 1.5%, and unless there are reasons to believe RBA will slash the interest rate further, chances is the Aussie may not weaken as much compared to last time. And also, RBA has mentioned that at this moment they can't decide whether Aussie dollar is too strong or not. Meaning to say, it's okay for Aussie dollar to go up, because in the past few years, because of the economy and the growth, RBA would prefer doesn't like Aussie dollar to be too strong for obvious reason. They want to export their raw materials, so with a weak Aussie dollar is better for their exports. And also with a weak Aussie dollar, it helps to help them to recover from their inflation, meaning they have set a target, but so far inflation has fallen short of their target. So if the Aussie dollar remains weak, it will help their recovery and also help the central bank hit their inflation target. So on the opposite side, if Aussie becomes too strong, it will hamper their so-called effort to hit their inflation target. So in the last few years, we have always heard when the Aussie dollar strengthened too much, RBA will tend to so-called jawbone it lower. So it will say things like, I think the Aussie dollar is too strong for the benefit of the Australian economy. But in the recent statement, they have come to a point whereby they can't justify the Aussie dollar is too strong at this moment. So meaning to say there's a possibility that even for Aussie dollar to go higher, the central bank may be feeling comfortable as well. And if you look at the China side, there seems to be a bottoming up of their slowdown. Yes, China has been slowing down, but the rate of slowing down seems to have tapered. As we can see, even their inflation rate has outperformed recently. So it could be a sign of a rock bottom. And once China hit rock bottom, let's say for example, then the next thing, of course, it will be to look forward to would be a gradual growth from China. And if China return back to a gradual growth, something closer to the 7% GDP, then that would be a boost to Australia's economy as well, since they are still the largest trading partner. I mean, China is still Australia's largest trading partner. Australia may not be China's largest trading partner, it's the other way around. China is definitely still Australia's largest trading partner in terms of imports and exports. So these are some of the reasons that I feel that to keep the Aussie dollar strength, holding up the strength of the Aussie dollar. Of course, we all know that for forex market, it is always trading the relative strength. So even if the currency is strong, if another currency is stronger, it will mean let's say for example, in this case, Aussie versus US dollar. Yes, Aussie is strong, but if US dollar proved to be stronger, example, if the Federal Reserve starts to increase interest rate, that will make it relatively stronger than the Aussie, then possibly we could see the Aussie dollar heading downwards. Oh, yeah, why is Aussie dollar so tough against the dollar? It is, so like I say, it is provided the dollar is strong, then it will make Aussie dollar appear weak. But if the dollar is weak for whatever reason, then relatively it will make the Aussie dollar appear strong as well. So if you see that Aussie dollar seems to be holding out well against the US dollar, it could mean the US dollar is not as strong as the Aussie at that point in time. So of course, why the dollar is not as strong in this year, especially if you recall towards the end of last year or towards the very early part of this year, the start of this year, the rate hike expectation is 3 times in 2017. So that's a pretty aggressive rate hike. And we are now towards another month will be the end of the first quarter. So there are only 4 quarters in a year. So if Federal Reserve don't increase interest rate by the first quarter, that means they have another 3 quarters to increase interest rate, which means the frequency would be higher. So as things goes by towards the January and February, with Donald Trump, president, mentioning he doesn't favor a strong dollar, and also from the policies he's announcing, causing a lot of uncertainties. So market has started to speculate maybe Federal Reserve will not taper as fast as what they expected. May not be 3 times, they are scaling their expectation to 2 times. So imagine last time when they buy into dollar expecting 3 rate hike in 2017, of course if the expectation now drops to 2 rate hike, there will be certain sell-off in the dollar to price out another rate hike. So that's the reason for January until current date, dollar has considered been weakened compared to the end of last year due to rate hike, due to scaling back of rate hike expectation. Okay, that's a pretty long explanation for a bit on fundamental side to explain the Aussie and the US dollar side. The next question, what made me decide where to enter the entry point with the rectangle? Okay. A bit explanation on this example. The orange area is the area where I feel that market is trying to make a decision whether to go up or go down. That will be somewhere in the orange area. Of course, slightly beyond the orange area, if it goes beyond the orange area, to me, market can still change its mind anytime. That's at least how I look at the market. So of course, I want the market to move further into the direction and close before I look at it as a confirmation that the market has made a decision to go in that direction. So for example, if 0.7685, that area over there is a point whereby market makes a decision. So as prices creep upwards to the area between the orange box and the green box, I can only suspect maybe market is going up. So I'm a bit conservative, because at that point in time, to me the market can still change its mind anytime. So I want the market to give a further push upwards and close inside the green box or higher before I treat it as a confirmation. Then I'll go in to long, expect it to go higher. Of course, even though I look at it as a confirmation, market can still prove me wrong. That's the reason I always put a stop loss regardless of what trade I take. So if the market really reverse, then I'll cut my trade and move on to the next trade. So for a simple so-called logic on how to put a stop loss, for this example, if I have gone in for a long trade in the upper green box, the immediate lower green box would most likely is the area where I place my stop loss, very conservative. And if the lower green box is where I enter, then the upper green box is where I would place my stop loss. So as you can see, it is a pretty conservative, pretty aggressive stop loss, pretty tight stop loss. It is about maybe 10 to 15 pips kind of range of stop loss. So similarly for the bottom entry, yeah, the same so-called criteria, I will apply it to the bottom trades as well. Wow, that's a okay. Thank you for the participation. There are a lot of questions. I like it. I'll answer all the questions as they come, instead of moving on to pairs and pairs without you understanding my logic. So I'll take the question until I finish all the questions, then I'll take on the next suggestion. Hope there's no violent objection to that. How do we derive the number of pips to trade on? Is it based on news or currency pair? Of course, if you ask a different trader will have a different set of criteria, but I'll share with you my set of criteria. So how I determine the number of pips, it is not fixed even for a currency pair or a time frame. It means that it can change even for a single currency, single time frame that I'm trading. Example, Aussie dollar H1. Maybe for this trade, as you can see, the stop loss is about 15 pips plus minus. And the next trade, maybe 2 days later or even 1 week later, my stop loss could be 25 pips or even 30 pips on the same 1 hour chart. So what I usually do, I let the chart tells me how many pips to take based on the volatility of the currency pair at that point in time. Because the volatility of the currency pair changes along the way. So certain times the same currency pair may be more volatile than other time. So that's the reason I don't really use fixed pips. If you have noticed the way I put my boxes, usually the distance is about 0.5 cm away from the decision area. So I know this is a bit discretionary to some of you. Is this what is 0.5 cm? I have I've shared my trading methodology last week. The entire week I've traveled to Singapore, Malacca and KL to share my trading methodology with a group of traders from our partners. So anyway, why I use 0.5 cm is because 0.5 cm will take into consideration the pair that I'm trading, the time frame that I'm trading, and the volatility at that point in time for the currency pair. So 0.5 cm will be fixed throughout my trading. But if I'm trading a daily chart, 0.5 cm could be 30 or 40 pips apart. But if I'm trading the M1 chart, for example, 0.5 cm could be just as little as 2 pips. So for those of you who have traded a multiple time frame, you'll know that if you put a 2 pips on the daily chart, you can't see the difference. Sometimes even for a 30 pips difference, it looks a 30 pips on a daily chart will look like a 2 pip on a 1 minute chart. Okay, because for daily chart the time frame is higher. It means it will show a greater volatility of the instrument or the currency pairs. So if the volatility is higher, you tend to set a wider stop loss or take profit for your trade. Okay, so hope that answer your question. I don't really have fixed pips. It depends on the currency pair, the time frame, and also the volatility at that point in time. So because of these 3 variables, after trading the market for so many years, I realized these 3 variables keep changing. So it is very hard to pinpoint a fixed pips to it all the time with 3 variables.